Before we go any further, let me ask you something important. If you find value in learning how the world's most successful investors think, if you want timeless principles that still work when trends fail, and if your goal is to become calmer, more confident, and more disciplined with your money, then pause for just 1 second. Hit the like button on this video and make sure you subscribe to the channel. It tells YouTube that this content matters, and it ensures you don't miss the next lessons in this series. Now, let's begin. Markets change, technology evolves, headlines scream new opportunities every single day. But despite all of that, Warren Buffett's investing philosophy has remained remarkably consistent across decades, through booms, crashes, bubbles, recessions, and recoveries. While countless investors chase trends, Buffett has quietly demonstrated something far more powerful: that discipline, patience, and long-term thinking outperform excitement and prediction. As we look ahead to 2026, the investing landscape will undoubtedly look different than it does today. New asset classes will emerge, new risks will dominate headlines, new narratives will promise fast wealth. Yet the core lessons Buffett has shared for decades remain as relevant as ever. In this video, we're breaking down the 8 essential Warren Buffett lessons, not as abstract ideas, but as practical frameworks you can actually apply to your own investing decisions in the year ahead. This is not about shortcuts. This is not about hype. This is about building financial fitness that lasts. Let's begin with the foundation of Buffett's entire philosophy. Lesson 1: buy and hold for the long term. One of Warren Buffett's most defining principles is surprisingly simple: buy great businesses and hold them for a very long time. Buffett has never been interested in constant buying and selling. He does not trade based on daily price movements, short-term news, or market noise. Instead, he approaches investing as if he were buying a private business, one he intends to own indefinitely. This mindset alone separates investors from speculators. When you hold investments over long periods, something extraordinary begins to happen: compounding. Compounding is not dramatic in the short term. In fact, it can feel boring. But over years, and especially decades, it becomes one of the most powerful forces in finance. Long-term ownership allows earnings to reinvest themselves, businesses to grow without interruption, dividends to compound rather than be consumed, time to smooth out inevitable volatility. Frequent trading, by contrast, often interrupts this process. Each decision introduces friction, taxes, transaction costs, emotional errors, and poor timing. Buffett has often said that his favorite holding period is forever. That statement is not literal, it's philosophical. It reflects a belief that quality businesses deserve patience. Another benefit of buy and hold investing is emotional stability. Markets do not move in straight lines. Prices fluctuate daily, often for reasons that have little to do with long-term business value. Investors who focus on short-term movements are more likely to panic during downturns or become overly confident during rallies. Long-term investors, however, can step back and ask a different question: has the business fundamentally changed? If the answer is no, then price volatility becomes noise, not a signal. This approach can help investors avoid emotional decisions that often lead to losses, particularly during periods of fear or excitement. Perhaps the most important idea behind buy and hold investing is this: stocks are not trading vehicles, they are ownership stakes. When you buy shares in a company, you are buying a portion of a real business with real employees, real customers, real products, and real cash flows. Buffett encourages investors to think like business owners, not traders. Owners care about competitive advantages, profitability, management quality, long-term demand. Traders care about price. In 2026, when markets will almost certainly be faster, noisier, and more emotional, this lesson becomes even more critical. Lesson 2: Stay within your circle of competence. Warren Buffett has never claimed to understand every industry. In fact, he has openly admitted the opposite. One of his most powerful ideas is the concept of the circle of competence, the set of businesses and industries you truly understand. This lesson is not about intelligence, it's about honesty. Your circle of competence includes how a company makes money, what drives its costs, what could threaten its future, why customers choose it over alternatives. If you cannot clearly explain these things in simple language, you are likely operating outside your circle. Buffett has avoided countless investments, not because they weren't profitable, but because he didn't understand them well enough to evaluate long-term risk. And that restraint has saved him billions. Many investors confuse complexity with opportunity. They assume that if something sounds advanced or sophisticated, it must offer higher returns. In reality, complexity often hides risk. Investing in businesses you do not understand turns decision-making into speculation. You are no longer evaluating fundamentals, you are guessing. Buffett's approach encourages investors to ask deeper questions, avoid fads, resist pressure to participate in every trend. This does not mean your circle must stay small forever. It can expand, but only through learning, experience, and time. Staying within your circle of competence does not mean stagnation. It means intentional growth. You can expand your circle by studying new industries gradually, reading annual reports, understanding business models before investing, learning from mistakes without rushing. In 2026, when innovation will continue accelerating, this lesson becomes especially important. Not every opportunity needs to be acted upon. Sometimes the smartest decision is restraint. Lesson 3. Never lose money. Protect capital first. One of Warren Buffett's most quoted rules of investing is this. Rule number 1, never lose money. Rule number 2, never forget rule number 1. At first glance, this may sound unrealistic. Losses happen, markets decline. Even Buffett himself has experienced drawdowns. So what does he really mean? Buffett is not saying losses can be eliminated entirely. He is emphasizing the importance of avoiding permanent loss of capital. Temporary declines are manageable. Permanent impairment is devastating. When capital is destroyed, recovery becomes mathematically harder. Compounding resets. Time must be spent rebuilding instead of growing. For example, a 50% loss requires a 100% gain just to break even. Avoiding large losses is often more important than chasing high returns. Another critical insight is Buffett's definition of risk. He does not equate risk with price fluctuations. He defines risk as the probability of permanent capital loss. This shifts focus from short-term price movement to business durability and financial strength. Companies with strong balance sheets, consistent cash flow, and competitive advantages tend to survive downturns far better than those built on leverage and speculation. Investors who prioritize capital preservation often demand a margin of safety, avoid excessive debt, diversify thoughtfully, and remain patient rather than impulsive. This mindset encourages humility. It acknowledges uncertainty and respects risk rather than ignoring it. In 2026, with economic cycles inevitable and surprises guaranteed, protecting downside risk may be one of the most powerful advantages an investor can have. Lesson 4. Have patience. If there is one quality Warren Buffett embodies more than any other, it is patience. He has repeatedly emphasized that investing success does not reward activity, it rewards endurance. Modern markets encourage constant engagement. News updates refresh by the minute. Social media amplifies every move. Commentators predict outcomes daily. But action does not equal progress. In fact, excessive activity often harms results by increasing transaction costs, encouraging emotional decisions, and distracting from fundamentals. Buffett has often waited years for the right opportunity and then acted decisively. Market volatility is inevitable. Prices will fall. Sentiment will shift. Headlines will create fear. Patience allows investors to ignore temporary noise, stay aligned with long-term goals, and avoid panic selling. Those who lack patience often exit investments at precisely the wrong time, locking in losses instead of allowing recovery. Patience also reframes expectations. Rather than seeking immediate gratification, patient investors focus on sustainable growth, business evolution, compounding over decades. This mindset reduces stress and increases consistency. It aligns behavior with reality. Meaningful wealth is built slowly, not overnight. As 2026 approaches, patience may feel increasingly countercultural, but that is exactly why it remains valuable. Lesson 5. Look for quality investments at fair prices. One of the biggest misconceptions about Warren Buffett is that he simply looks for cheap stocks. That is not true. Buffett does not hunt for bargains in the traditional sense. Instead, he looks for quality businesses and then waits until they are available at fair or reasonable prices. This distinction is crucial. A quality business typically has consistent and predictable earnings, strong cash flow, durable competitive advantages, capable, disciplined management, a business model that can endure economic cycles. Buffett understands that a great company can still be a poor investment if purchased at an inflated price. At the same time, a mediocre company is rarely a good investment, no matter how cheap it appears. By prioritizing quality, investors reduce the likelihood of permanent capital loss. By insisting on fair prices, they preserve the potential for long-term returns. As markets evolve, valuations will fluctuate. Periods of optimism will push prices higher, while fear will create opportunities. Rather than trying to time the market perfectly, a task even professionals struggle with, this lesson encourages a different mindset. Focus on fundamentals and allow valuation to guide patience. When market sentiment shifts, quality businesses often remain strong even if their stock prices temporarily decline. For long-term investors, this creates opportunities to acquire ownership in solid companies without chasing momentum. This principle shifts attention away from short-term price movements, social media narratives, and headlines designed to provoke urgency, and toward earnings consistency, return on capital, balance sheet strength, and long-term growth potential. In practice, this approach requires restraint. It means waiting when prices are too high and acting when fear creates mispricing. Lesson 6. Don't get into debt. In 2026, when market cycles will continue to test emotional discipline, focusing on quality at fair prices may provide a margin of safety that speculation cannot. Debt is often marketed as a tool. Used carefully, it can accelerate growth. Used excessively, it becomes a liability that erodes flexibility and increases vulnerability. Buffett has consistently warned against excessive debt, both at the corporate level and in personal finances. Debt comes with obligations, interest payments, reduced cash flow, and limited freedom during downturns. When markets decline or income becomes uncertain, debt does not adjust. It demands repayment regardless of conditions. For individuals, excessive debt can force premature liquidation of investments, increase stress and emotional decision-making, and reduce the ability to stay invested during volatility. For businesses, high leverage can limit reinvestment, increase bankruptcy risk, and magnify losses during economic contractions. One of Buffett's understated advantages has been financial flexibility. By avoiding unnecessary debt, he preserves optionality, the ability to act when others cannot. In downturns, companies and investors burdened with debt often become forced sellers. Those with strong balance sheets and liquidity, on the other hand, gain opportunities. This lesson reinforces an important truth. The absence of debt can be just as powerful as the presence of capital. Long-term investing is not isolated from personal financial behavior. High debt levels can undermine even the best investment strategies by forcing short-term decisions. Reducing debt may improve monthly cash flow, increase emotional resilience, and allow investors to remain committed during downturns. As we approach 2026, economic uncertainty will remain a constant. Lower debt levels may provide stability, not just financially, but psychologically. Lesson 7. Think independently. Few lessons are more difficult or more valuable than this one. Buffett has long emphasized the importance of independent thinking. He does not invest based on popularity, trends, or crowd behavior. He invests based on his own analysis and conviction. Markets are social systems. When prices rise, confidence spreads. When prices fall, fear multiplies. Following the crowd often leads to buying near peaks, selling near bottoms, and overreacting to short-term narratives. Independent thinking does not guarantee success, but it reduces the likelihood of emotional mistakes driven by social pressure. Buffett's approach encourages investors to ask, is this asset priced reasonably relative to its fundamentals? Does it align with my long-term goals? Do I understand the risks involved? If the answer is unclear, popularity should not override caution. Independent thinking requires the confidence to say no when everyone else says yes, and the courage to act when others hesitate. By 2026, information will move faster than ever. Opinions will be louder, predictions will be more confident. Independent investors must develop the ability to filter noise, resist urgency, and separate facts from narratives. This does not mean ignoring new ideas. It means evaluating them through a disciplined framework rather than emotional momentum. When decisions are grounded in research and valuation, investors are less likely to be shaken by market swings and more likely to act rationally when opportunities arise. Lesson 8. Invest in yourself. Perhaps the most underrated of all Buffett's lessons is this one. The best investment you can make is in yourself. Unlike stocks or real estate, personal development cannot be taxed, diluted, or taken away. Its returns compound over a lifetime. Buffett has spent decades reading, learning, and refining his thinking. He views knowledge as cumulative, each insight building on the last. Investing in yourself may include financial education, skill development, professional growth, and understanding personal strengths and limitations. These investments may not produce immediate financial returns, but over time they often yield exponential benefits. Personal development does more than increase earning potential. It improves decision-making across investing, career choices, risk management, and long-term planning. Greater self-awareness and competence reduce reliance on external validation and speculation. This aligns directly with Buffett's emphasis on independent thinking and patience. Unlike financial assets, self-investment compounds in non-linear ways. Confidence grows, judgment improves, and opportunities expand. In uncertain environments such as those likely ahead in 2026, adaptability and skill may become as valuable as capital itself. This lesson reminds us that wealth is not only financial, it is intellectual, emotional, and strategic.